The latest US macro data suggests that a US stock market sell-off is imminent. This is the latest piece of stock market news we need to be paying attention to. And I'm going to show you in today's video exactly why that data narrows down the window to September, as well as a new quantitative signal which has triggered, which previously picked the top in the S&P 500 and now suggests that the next leg down in the S&P 500 may already be underway. I'm also going to show you at the end of the video the monthly target levels for the S&P 500, the Nasdaq, the Dow Jones, and the Russell 2000. US manufacturing activity contracts for a fifth straight month, reported by Bloomberg. ISM August factory index at 47.2 after 46.8 a month earlier. But this is the key that we're going to look beyond the headline number. Orders gauge shows steepest contraction since May 2023. US manufacturing activity shrank in August for a fifth month, reflecting faster rates of declines in orders and production. The Institute for Supply Management's manufacturing gauge edged up 0.4 points to 47.2. Data out on Tuesday showed a reading below 50 indicates contraction. And if I pull up this chart, you can see not only has US manufacturing shrunk for a fifth month in a row, but it's been in contraction territory, so below 50, for 21 out of the last 22 months in a row. So the manufacturing surveys have been pointing towards a recession in the US for the last nearly 2 years. And this has led some people to say, maybe this doesn't work anymore. Maybe this data is not working like it used to. But they've been saying the same thing about the yield curve, which now we are entering, or we have already entered, into the longest period of yield curve inversion in history. But you're going to see in today's video why actually, if we look past the headline number, the data is suggesting that now we are looking finally for this data to feed through into the stock market. The S&P 500 and Treasury yields remained lower after the report. The group's measure of production slid for a fifth month deeper into contraction territory and to the lowest level since May 2020. The gauge of new orders, which is one of the keys we're going to be looking at, which showed bookings are shrinking, dropped to a 15-month low. Export orders, which is the second thing we need to pay attention to, also shrank at the fastest rate since the start of the year. There's no doubt that the interest rate reductions that will come probably in September are going to help, but I'm not so sure they're going to help in the short term. Chair of the ISM's Manufacturing Business Survey Committee said on a call with reporters, "We're not going to see things really start to change here until December or January." So a couple of really important takeaways. The ISM Manufacturing Survey has been pointing towards US recession for the past 21 or 22 months. And the second thing is to note that the data is now weakening materially, and it's not likely to improve until 2025. And I'm going to show you next why the September window does look the most likely for a stock sell-off in terms of the macro data. And then I'm going to show you also the quantitative signal, which has triggered just yesterday, which suggests there's a good chance the next leg down in stocks has already begun. So the first component I want to look at in the report, looking past that headline number, is the new orders component, because this is a leading component of the survey. And I want to show you why the new orders data puts a stock market sell-off right around this month of September. ISM's new orders index contracted in August for the fifth consecutive month, pay attention to that, registering 44.6%, a decrease of 2.8 percentage points compared to July's figure of 47.4%. The new orders index hasn't indicated consistent growth since a 24-month streak of expansion ended in May 2022. Of the 6 largest manufacturing sectors, only one, computer and electronic products, reported increased new orders. And the report goes on to point towards the reason for this deterioration in new orders as the confidence in the future economic environment remaining at its lowest levels since the coronavirus pandemic recovery. So the new orders component has contracted now for the 5th month in a row. And why is that especially important? And why did I tell you to remember that statistic as we went through that part of the report? Well, if I pull up this chart, you can see exactly why that statistic is so important and narrows the window down to this month, because the ISM new orders component leads GDP in the US by 5 months. So what that means is the new orders component of the report, which just came out, which started to contract 5 months ago, means we are now at the point where we should expect based on the new orders component, GDP in the US to start contracting. Why is that important? Because as GDP in the US contracts, the stock market tends to sell off in line, coincident with the underlying contraction in GDP. So what tends to happen is the stock market will sell off, and then GDP gets reported as being lower at the end of the quarter. The stock market rallies, and then at the end of the quarter, GDP is reported as being higher. So that's key to understand, because by the time the GDP data is printed, the move in the stock market has already happened. So if the new orders component leads GDP in the US by 5 months, and it started contracting 5 months ago, this is telling us right now we should be expecting US GDP to soften. The next component to look at is inventories, because the inventories index registered 50.3% in August, up a substantial 5.8 percentage points compared to the reading of 44.5% reported in July. Manufacturing inventories grew as a result of panelist companies adjusting to lower new output levels. So at the same time as we're seeing new orders coming down, in the report, we're seeing inventories going up. And why is this important? Well, if I pull up this chart, you can see ISM new orders to inventory spread. So we're talking about the ISM new orders minus inventory. This is a spread which is well known to track economic growth in the US. And you can see previously when this spread starts to move below 50, this tends to signal not just a softening of GDP, but also a sell-off in the S&P 500. Why? Because the last 2 times we saw this, we had the COVID crash of 2020, and we also had the bear market, the technical recession and bear market of 2022. So yes, we've had the headline numbers showing below 50 contraction for the last 21 out of 22 months, but we're now only just starting to see new orders versus inventories getting to a point where a softening of GDP and a sell-off in the stock market is being signaled. So we can also look at new export orders. And if you look at new export orders, the index registered 48.6% in August, down 0.4 percentage points from July's reading of 49%. And the new export orders index reading indicates that export orders contracted for a 3rd month after expanding in May. So why is the new export orders component important here? The fact that it's been contracting for 3 consecutive months now. Well, if I pull up this chart, you can see that the export orders component tends to lead the ISM manufacturing headline by around 2 months. So what we're seeing here is we're seeing confirmation in the data of what Fiore said before, which is that it doesn't look like we're going to see a pickup in the manufacturing data over the next few months. Why? Because if the new export component leads the index by 2 months and it's been contracting for the last 3 months, it suggests we're about to see the ISM going even lower over the back end of this year. And the final thing to note here from new export orders is that the survey states the reason new export orders remain sluggish is because international trading partners continue to struggle with weak economies. So what we're seeing here is we're seeing a slowdown within the US when we look at the new orders and inventories component and also the headline. But we're also seeing that we're looking at a global slowdown here because the export component of the survey is also underperforming, and it specifically states that this is because of weakness in other economies globally. And the brand new JP Morgan Global Manufacturing PMI released yesterday picks up where the ISM survey leaves off, and it states that global manufacturing production, new orders and employment all declined slightly in August. The key findings of the report were that global manufacturing PMI is at an 8-month low, new export orders fall for a 3rd month running, and input cost increases lead to higher selling prices. But if I pull up this chart from the JP Morgan Global Manufacturing PMI report, you can see what's important is that global manufacturing is going into contraction territory back below 50 once again, confirming the data in the ISM survey that we're looking at a global slowdown, not just a slowdown in the US. And so the final thing to note also is the seasonality. Before we move on to the quantitative data, it's important to remember that going into September and also kind of Q3, Q4, this is seasonally the worst time for stock markets. As this Bloomberg headline points out, treacherous September is leaving traders everywhere on edge. Month has typically been bad for stocks, bonds and gold. Jobs data, Fed decision, election among sources of volatility. September has traditionally been a terrible month for traders, and risks being even harder to navigate in 2024, given lingering questions about the Federal Reserve's anticipated interest rate cut. Bonds, stocks, and gold have typically suffered losses in the month as traders reassess their portfolios after the summer break. the S&P 500 index and the Dow Jones Industrial Average have had their biggest percentage losses since 1950 in the month of September. And you can see over the last 5 years, the index, i.e. the S&P 500, has slumped 4.2% on average in September in the past 5 years. So not only does the macro data put a sell-off and a slowdown right into September, October, which is where we are now, it's seasonally the worst period for stock markets as well. So now let's have a look at the stock markets themselves. And I want to start with this quantitative signal that triggered yesterday and previously picked the top in the S&P 500. So if we jump over to the HedgeDash quantitative analytics platform, you can see the VIX is sitting at the top of the index performance metrics. And this is a very important risk off signal which triggered yesterday. Why? Because the last time we saw this, it picked the top in the S&P 500. If I pull up this internal data from the HedgeDash system, you can see that yesterday we got a change in the score of the performance metrics of the VIX. It previously sat at 0 and yesterday it flipped to a score of 1. And so you don't have to take my word for it. Here is the quantitative data for the last time we saw the VIX flipping from the negative side to the positive side, or in this case into neutral, in the HedgeDash algorithm. It was back on the 17th of July. This was when we got that same signal to suggest that risk off was coming into markets. And so if I pull up the S&P 500 in the HedgeDash platform, you can see the 17th of July was right there. So on this day, and you could have been forgiven if this is all the data you had, you could have been forgiven for thinking that this was a buy the dip opportunity. But right on this day, we got exactly the same signal. That switch in the VIX from risk on to risk off, that signaled that actually we should now be looking on a forwards looking basis for risk off to come into markets in all probability. Nothing is guaranteed, but in all probability. And you can see we did in fact get the decline following that first down day in the S&P 500. But it was actually the VIX signal in the HedgeDash algorithm which foretold a potential sell-off in the S&P 500. So if we come back and look at the chart, what I want to do is I want to show you, based on the projected probable ranges in the HedgeDash platform, where the downside targets sit in the indices should we get a continued sell-off. And what could be the spark for a sell-off in the S&P 500? It could be non-farm payrolls, which is coming up on Friday. So if I turn the monthly levels on for the S&P 500, you can see we've got two downside targets here in all probability. We are already making our way to the 5464, and in a normal week or a normal month, if we were to trade into this, this should generally speaking hold the S&P 500. However, we have a technical problem here, which is that this sell-off, this raising of volatility over the last day or so, has come after a failure to make a new high in the S&P. Now, technically speaking, when you fail to make a new high in an asset and you start to see liquidation coming in, you start to see long positions or buyers in this area pulling their long positions before the asset makes a new high, very often you see a run back down to the prior low. In this case, that puts that about 5.1, 5.20. So there is a real risk here that we are looking, not just from a macro perspective, but also a quantitative perspective now, at a continued decline over September, October, and perhaps even into the US election. So if we do get a continued sell-off, the second downside target this month, so for September, is the 5279.89. If we trade down below this, this is where we become extremely oversold intra-month, and in all likelihood, that should cap downside in the S&P. Now, what's really interesting about this is, if we push through here, it looks like we're going to trade into the 200 moving average. And any continued sell-off in this market is likely to come down and test its daily 200 moving average as well. Very often this holds the market, can be a good buying opportunity. But certainly the 5279.89 in a bigger sell-off and then into the daily 200, these are the targets I would be looking for any downside in the S&P 500. If we come and have a look at the Dow Jones, you can see we've still got quite a bit of room down to the 40292. This is the first monthly target to the downside. And if we're breaking through there, if you get a stronger sell-off, then you can look down to the 39021.85. That's the second monthly target to the downside in the Dow Jones. And what's interesting again is if we do start to sell off and we get a bigger sell-off in these markets, that takes us right into the daily 200 moving average once again. So I do expect, whether it's this month or next month, if we get a sell-off, and don't forget non-farm payrolls on Friday can affect the markets, can actually change things in the markets. But if we get that sell-off, look for the 39021 and also that 200 daily moving average kind of intersection in the Dow Jones. Next is the Nasdaq composite. Now you can see the Nasdaq really suffered, especially relative to the other markets. And part of this was because we also saw Nvidia receive a subpoena, and that added to a sell-off. I did in fact do a video very recently about SMCI and also Nvidia, and how, you know, there are some allegations from the short sellers about fraud involving SMCI, but are, you know, something which people are looking at Nvidia and asking why they're associating with that and looking at their own returns. But certainly this subpoena given to Nvidia has also aided in this sell-off recently in the Nasdaq. We still have plenty of downside just to the first lower bound at the 16727.22 this month. And if we break that, if we get a bigger sell-off, maybe catalyzed by non-farm payrolls, you can look down to the 200 moving average, of course, but also the prior low. The prior low, remember I said, if you start to get a failing of a high, so you see buyers come in and they're trying to push this to new highs technically, and then they pull their positions and you see it reverse, very often the prior low is a very good technical target. And that would actually fit in with the second price target to the downside in terms of its probable range, the 15740.83. So I would not be surprised, this kind of ABC, to see the prior low taken out in the Nasdaq composite. And finally, we have the Russell small caps, and we still have quite a bit of downside left into the first target or the first lower bound in the monthly time horizon here. And that's at the 2084. So you can write that down, put that on your chart, because at the 2084.60, you should expect to see at least a bounce near term in the Russell. That is the first target to the downside. And again, if we break through here and we start to trade below the 200 moving average in the daily time frame, you can see a test of the prior low is also on the cards. And if we break through there, you can also look at the second target to the downside this month. And these are just for this month at the 1951.57. And that would be that kind of ABC sell-off as well. So that is it from me for today, guys. As always, I hope you enjoyed today's video, and if you did, why not consider joining us in the GMT training room each day, where I look at the best markets as well as sharing real-time setups that I'm personally looking at trading with members as part of our GMT training program. Don't forget, you can also get a 2-week free trial to the cutting-edge hedge-trading app used in today's video by heading over to www.hedge-.com. Access to the cutting-edge hedge-platform is included with every GMT membership.